Hey there, welcome to another edition of Road Noise with Hutch from the Hutch 20 Minutes podcast. Today we're going to talk about the psychology of debt and the shift that needs to take place to move from traditional financial thinking, which you'll see, even if you're quote unquote out of debt, you're still actually in debt. And we're going to build upon a principle that was brought up by Nelson Nash in the original book, Becoming Your Own Banker, the Infinite Banking Concept. In chapter 6, he says, you finance everything you buy, even if you pay cash. You either pay somebody for the use of their money or you pass up the ability to earn interest on your own money. I'm paraphrasing. And he goes on to talk about this concept called EVA, or economic value add, that was all the rage in the early to mid 90s in corporate finance. And we'll talk about how to apply that big institutional thinking down to the personal, family, small business level when becoming your own banker, and how all of this thinking helped inspire me to come up with the 40 banking system, which is the ultimate in privatized banking. So let's first talk about the psychology of getting out of debt. It's very popular in personal finance. Obviously, Dave Ramsey harps on it as the ultimate. But if you think about it, if you're really, really trying to get out of all debt, where do you go from there? And velocity banking, we are actually going to take a page from the Velocity Banker's book, but even velocity banking is all about more strategically managing your cash flows and juggling your debts to the most efficient loan products so that you can lower the overall volume of interest you pay and accelerate the debt payoff. But again, it's like, where do you go from there? But in 40 banking, we are actually going to apply a lot of those principles from velocity banking, which is really just efficient cash flow management. Combine them with infinite banking in this corporate finance concept of EVA, or economic value add, to construct the 40 banking system. But just circling back to anybody out there, and it's okay, I'm not here to make you wrong. I'm just here to make you think critically about what you're doing and what it means. Let's just say you achieved that goal of being debt free, or you're on your way, or you're close, you're within striking distance. Well, if all your house is paid off and now you're kind of starting building assets from zero, right, from dead even, you missed out on a lot of compounding. We'll get into that later. But even forgetting that, if you have cash in a quote unquote high yield savings account or low yield savings account, the actual asset of cash is a debt instrument. It's not your debt, but some people call them Fed coupons. And they're printing that stuff like it's going out of style. And interestingly enough, money is created through banks. Banks have the power to create money supply by issuing debt. So when you hold cash as an asset, I agree that cash is the most fungible token, to take a word from the crypto bros, but it's actually not their word. Fungible just means very easily and readily exchangeable. A non-fungible token, whether it's a picture of a monkey or access to a certain music library or a Discord channel, when you have a token, a non-fungible token, it's just saying it's not a ready market, right? There is a ready market for stocks and bonds. A less ready market, like with real estate, you have to kind of negotiate a fair market value. With heavily traded stocks and bonds, when there's a lot of volume, it's more fungible than real estate, but still less fungible than cash. Like cash, pretty much anybody will take at any time, anywhere. Well, until they don't. There's been other instances in history where fiat currency, it works really good until it doesn't. But I still agree that now and probably for the foreseeable future, cash is the most fungible token, but it's still a debt instrument, right? Our US Treasuries, T-bills, which is really money markets and high yield savings accounts are just stashed in T-bills. It's just issuance of debt, just low yielding debt by the Fed and the federal government. So you're still kind of in debt. It's not your debt, but it's somebody else's debt. And what's really interesting about it is the fact that they've been so irresponsible with their debt. If you're holding cash, it's a lot less valuable than it was, say, 5 years ago. You think you can't lose money. You think it's FDIC insured, but if you had $100,000 in cash before COVID, it probably spends like $70 or $75,000 right now, depending on what you buy. I mean, inflation is a manipulated metric. It's a select baskets of goods and services from select cities, but you get the point. Cash is trash. It's debt. It's a means of exchange, but you're still in debt. Let's say you're in index funds or dividend stocks, blue chip stocks, whatever you want to call them. I have no debt. House is paid off. I have no credit card debt. I got my emergency fund and high yield savings, and I got money in my brokerage account in Vanguard funds or the best dividend stocks. If you look at the balance sheets of these highest quality stocks, lowest volatility, dividend paying stocks, there's a crap ton of debt on their balance sheet because that's just a principle in corporate finance. They know they can get a better bite of the apple. And that's part of the reason why your dividend stocks go up is because you're entrusting expert managers to allocate capital efficiently so that the value of that investment goes up. And part of why it does is because they take on debt at low interest rates or lower interest rates than what they can get a turn on those dollars for. And you're essentially, when you're buying the company, you're not lending the money. But if you have any bonds in your portfolio, that's what bonds are. You're either lending governments your money or you're lending investment grade companies, highly rated companies, your money. They're using your capital. They're getting a better rate of return off that money, and they're giving you a coupon rate. But if you own these assets, those assets are still in debt. And so the people that are just freaking out, having to be totally out of debt, I mean, you have to, I guess, have a house free and clear, probably not owe any property taxes because that's a debt that can be changed or whatever, and have a bunch of gold, silver, and farm your own food, maybe some bullets and guns to protect it. This is hyperbolic, but I want you to see the point that the debt-free dream is really unattainable. And so that brings us to the evolution where we go, say, from Dave Ramsey's envelopes to velocity banking. And it's like, okay, let's manage debt efficiently as possible. Sorry about that. I got a phone call. Anyway, so the debt-free dream is a lie. The velocity banking principles is sound in terms of cash flow management. But again, it's like if you're going to go through all this effort and take on this new financial discipline and have it be rote behavior, why stop there? Why not apply that thinking to building cash flowing assets? And if we can get a better turn of the dollar with assets that appreciate or cash flow or both, then do we want to do it sooner or later? Do we want to start that compounding earlier or later? Probably earlier. And then it comes down to not just like, debt, I got to knock out debt. It's more so just measuring every single dollar in the cash flow like you would do with velocity banking and apply that to asset building, apply that to building reserves, apply that to building sources of liquidity in reserves that can't be taken away from you. Apply that to liquid capital that can be invested and borrowed against to create liquidity when needed, and being able to do so where it can't be taken from you. I love the saying by Bob Hope, a bank is a place that will loan you money if you can prove you don't need it. That absolutely proved to be true. During 2009, I had a HELOC revoked, which, by the way, a HELOC is a home equity line of credit. And that is one of the main tools of velocity banking, right? To use this simple interest line of credit that's flexible, but you have to be careful because even though that's a nice place to borrow capital because you're just borrowing against the brick and mortar that's trapped inside your primary residence, it can be taken away. They can freeze it. They can, depend, you have to look at your language. They can call it sometimes. Most of the time, they'll just freeze the balance you have. But even if you have untapped balances that you were counting on to take advantage of generational buying opportunities, or maybe you're in business and when the sky starts falling, you need that capital to keep your business going, kind of like JCPenney did, the bank may decide that they no longer want to lend you money, that you're not as good of a customer as they thought you were when they issued that. I know my plan is to look for canaries in the coal mine. That saying is when they would drop a canary in a cage down in a coal mine, and if there was those deadly gases, then they'd pull the canary up and he was dead. And so they would have this preemptive signal before they went ahead and deployed actual miners down there. Poor little canaries. But that's where the saying comes from. And in 2009, there were those signs long before the major October debacle happened with AIG in June. I digress. Let's bring it back to the psychological shift of banking. So Nelson Nash, in his book, Becoming Your Own Banker, The Infinite Banking Concept, first started talking about this principle, this shift that I think everybody needs to adopt. Whether you're going to get a life insurance policy or not, if you're all about maximizing the turn of every dollar in your cash flow model, he brings up a great point, and it's in chapter 6, and it says, you finance everything you buy, even if you pay cash. You're either paying somebody for the use of their capital, or you're passing up the ability to earn interest on your capital. So you're either paying somebody interest for the use of their capital, or you're passing up the ability to earn interest on your own capital. And that was really telling. And a lot of times when I share that with people, it kind of hits them, especially if they're in this, get out of debt, try not to get a car payment, pay it down early, pay down the mortgage early. They realize that they're really just two sides of the same coin. And that what we need to do is we need to measure the efficiency of dollars. And Nelson actually gives a model to do this. It's not his. It came out actually before infinite banking, came out before velocity banking, and it's a corporate finance concept called EVA, or economic value add. And economic value add was brought about by some very astute corporate consultants, and they ended up advising some of the biggest and well-known companies of that era, the Coca-Colas, the AT&Ts, the CSX Railroad, just to name a few. Really, really big companies. And what they found is when these companies actually went into debt by issuing bonds, like we talked about, right? When they issued debt and took on debt, they were actually more measured in how they use the money. But with older legacy initiatives, this is the way we've always done things before, that were funded out of ongoing cash flow of the company, operating cash flow, or funded out of retained earnings. They didn't have quite the same level of due diligence or just ongoing effectiveness of that money. And what EVA said is basically what Nelson said, is there's always a cost to money. You finance everything you buy, and we need to, whether you're paying somebody for the use of their money, whether you're passing up the interest you could have earned on your own money, and what we need to do is we need to attribute a cost of money to every single dollar. And we need to make sure that our managers are beating that. They're making sure they're using those dollars effectively. This again can be echoed in with the CFA, Chartered Financial Analyst. So there's always something called what's the risk-free rate of return, and what extra premium is the stock, the company, the mutual fund manager, what extra risk premium are they earning over and above the risk-free rate of return, and is it worth the risk or the volatility I'm taking? These are the types of things they measure. And I will say that mentality has helped me more than once when I have life insurance policies that aren't knocking the cover off the ball, but even in like the lowest interest rate environment, only earning, call it 4-ish%. But in my tax bracket, that felt closer to 8%. When somebody came forth with an investment that was maybe paying me 10 taxable, but it required me separating and having my capital be illiquid for long periods of time that I can't control and not sure when I'm going to get it back. And I can't really affect the outcome. It's not my own business. I'm a lot more cautious. Like, I don't know if that risk premium is worth my strained liquidity, especially since if I just leave it there, it's doing pretty well net. And actually EVA did take into account taxes. That was actually part of the metric. And so I think it's important to apply the same level of psychology to realize that, first of all, you're never really out of debt. If you hoard a bunch of cash, you're just holding somebody else's debt. If you have a bunch of blue chip stocks, well, you're applauding managers who are managing debt well in their own activities. And so the idea behind velocity banking, infinite banking, using life insurance to build your own bank, and then 4D banking, what I've come up with, where we combine a network or a matrix of different asset classes and their loan options, not to mention different types of growth that hopefully is non-correlated to each other or less correlated to each other. So it's like the analogy of the pistons firing. It's what diversification with the stock portfolio used to be, when small caps were that much different from large caps and that much different from international. Nowadays, as a global economy, we're all tied together at the hip. And so it's not like when one piston goes down, they all go down, it seems like. But with the 4D banking system, to actually have it to where your different investments, which like needs to be beating inflation, because the declared rate of inflation that they're stating, which by the way is coming from printing all kinds of debt of this cash we're holding. In order to truly beat inflation, you have to have assets. So I would just say the net after tax rate of return on a life insurance policy growth, like if you're getting, call it 5-ish, whatever, high 4s, 5-ish, low 6s, depending on the type of policy you have, and it's yielding whatever that net after tax 7, 8, 9, 10, whatever that looks like for you. Guess what? That's almost like par these days, just to keep up with, just to have your dollars retain their purchasing power. Like we talked about, if you just kept money in a mattress from before COVID, you didn't lose anybody, but you lost purchasing power, a lot of it. So it was like it's losing money safely and slowly, as opposed to taking risks in the real estate market or the stock market, or through your own business, or through, starting a new side hustle, or whatever that looks like. But the idea is, if we're going to borrow this liquidity, and hopefully you're doing it where you have more access, knowledge, and control, you can be getting a better bite of the apple than the risk-free rate. And that's why I love the life insurance policies, because when you look at these risk-free rates, A lot of times they're pretty low or they're not inclusive of taxes. But like if I just use my life insurance policy as kind of the measure, like, you know what, I really don't have to do much at all and I can earn this. And so I'm going to be more selective about how I use this liquidity. And if I'm going to deploy my liquidity, whether I'm going to spend it, right, just to keep up operations, or whether I'm going to invest it to produce more cash flow or appreciation, or both, ideally, I'm going to be a lot more measured in how I do that, just like the managers who were trained under EVA. Um, Going a little bit over this time, I realize, but I think it's a great concept. So I'm just going to touch upon the different asset classes in the 4D banking system. There's four key ones. So one is the life insurance that we mentioned. And again, we'll get into that. Life insurance, stock portfolio brokerage account, like an after tax one, where you can actually borrow against it while keeping it compounding. There is risk to that, but less so if you also have it paired with the life insurance policy. Excuse me. It's going to be hard assets. That would be like real estate and precious metals, commodities, whether that be through proxy or actual precious metals. There is some value to having some actual precious metals, which we'll go into when we talk about the 4D banking system. And last, having some retirement accounts, which I realize a lot of infinite bankers are dead set against, because again, you do lose a lot of control. But again, if you're going into a retirement plan like a 401k, a self-directed 401k, and you know that your liquidity is going to be strained to a degree until you're 59 and a half, and you know that there's going to be taxes on the other side that you can't control, well, then you invest a little bit differently, right? And you actually treat that 50K like it's just another emergency fund. And that's the idea is you want to have, remember, a bank is a place that will loan you money if you can prove you don't need it. So you want to have multiple different sources of liquidity that can't be yanked from you. And so whether you have a company 401k, now that one can be, because if you get fired, you have to pay it back within a month or two, less take the distribution and penalty. I will say, if you can't get a job after that, that might be a great time just to extract some liquidity from the 401k. Even if you have to pay penalties, it probably means that you won't be in as big of a tax bracket. But ideally, you have your own business, or you can start a side hustle where you can also set up a solo 401k, which, by the way, you can roll in old IRAs. And now, since you're never going to fire yourself, there's a line of credit that can't be taken from you. Going back up, the ones we just talked about. So we talked about retirement plans. Roth account, again, it's illiquid, it's nice, but it's always going to be a single use asset, because Roth, you have to spend it. Like, you can't borrow against it and keep it compounding. You just let it in there grow, rack up a big number, you have to spend it. But since you paid with after-tax dollars, there is some access there. You can take principal prior to age 59 and a half. So with a Roth 401k, it does get a little dicier just how basis is calculated, but it is possible. We're not going to get into that today. Going up, precious metals, if you actually have physical gold and silver, there actually are multiple places where you can get precious metals loans. So you can actually ship them off. You can actually go to a pawn shop, quite frankly, and borrow against it for just very temporary liquidity, or you can sell your assets, right? And they call it, what do you call it? Gold bugs call them LCS, local coin shops, but there's tons of options. That's always going to be pretty fungible. There will always be, it's almost like a real estate commission on the way on the way in and on the way out. But in the ultimate emergency, where just the sky has been falling and you're dollar cost averaging into the dip, whether it's real estate or stocks or whatever, with your available liquidity, and it keeps falling. If we look back in history, gold has sometimes been crashed like just really quickly, right when things go down, but then it V's up almost right away. And it's true whether you look at the 2000s, 2008, COVID in 2020. If you look at these examples, you'll see that gold just quickly recovers because it's the fear premium. And so when everything else is down, a lot of times gold will hold its value or even go up. But there are often opportunities to take advantage of the early dip because people are just going sell, 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 and throwing the baby out with the bathwater. Stock portfolio. This may be one of the best first stops for borrowing. And that's because a lot of times you can get the lowest rates. So back when I could borrow against my life insurance policy at 2.75 with the cash value line of credit, I could borrow against just my brokerage account, Interactive Brokers, for 1.75. And if I got a big enough loan, it got all the way down to like 1.5. There's S blocks, securities backed lines of credits, but brokers like Interactive Brokers and Robinhood, even like they have very competitive margin loans today around the low to mid sixes right now. The other thing about that is since it's investment interest, you're actually using that loan to carry investments. So even if you just borrow against it for other things, technically you didn't sell the investment. So you're using the loan to carry investments. It's a good way to rinse expenses that maybe wouldn't otherwise be deductible by using it as investment interest, by not selling your assets, keeping them compounding, which we talked about early, like, so you don't pass up the ability to earn interest on your own money, but there's a little bit of tax efficiency with how that loan can be construed. You have to be very precise with your record taking, like source it exactly as such. But that is a great first stop. And then using a life insurance loan as the ultimate backstop. Well, they're all kind of tied for ultimate backstop. The 401k loan, the precious metals loan. I would probably go in this order most of the time: stocks, then life insurance. I can move them very quickly, pretty fungible. And then I would go to either the retirement plan and or the precious metals, depending on the ease and the agility and the speed I'm able to do so. Oh, and obviously the HELOC, borrowing against hard assets, real estate, whether you have a HELOC against your primary residence or you have it against investment property, I think it's good to set those up, even if you're planning on not using them. So there's certain HELOCs, if you don't have great credit, where there is going to be an origination fee. They do require an initial draw, but if you have good credit, and you have a good institution, different credit unions, and you can shop them, a lot of times, like I was able to set one up and get pretty good liquidity, like several, like 450,000 of available line of credit without having to pay a fee, origination, or without having a minimum draw. And there was an early, promotional rate. Anyway, we'll get more on the cash flows, like really applying that velocity banking mentality of each dollar that comes in and out, being super diligent about where it goes to minimize the volume of interest, maximizing the compounding of your other assets, maximizing the tax efficiency by getting that deductible investment interest against future investment income, which, by the way, that can include rents, dividends, whether it's qualified or ordinary, capital gains, whether it's long-term or short-term. So having that investment interest, as long as you itemize your deductions, don't take the standard deduction, that's a really nice benefit to have. And you can never run out of them. You can, even if you don't use them in that year, if you have a bunch of losses, it's like capital losses where you can bank it against future years. So anyway, hopefully this helped you shift your mindset. I know we got into tactics a lot, but just remember, you finance everything you buy. You either pay somebody for the use of their money or you pass up the ability to earn interest on your own money. And so the idea is start to think about the sum of the parts in the context of the whole.